Hi everyone, I think the participants are joining in. We'll wait for 2 more minutes before we start the session. I think enough people have joined, so I'll start the session. Hi, good afternoon, everyone. I would like to begin with wishing you a happy Holi and all the women participants a very happy International Women's Day. My name is Jatin Agarwal and I'm part of the business development team at ASK Investment Managers, and I welcome you to the first edition of the knowledge series that ASK started on ASK Growth Portfolio. I'll be your moderator for today's call. Today, Mr. Sandip Bansal, who is the Senior Portfolio Manager of ASK Growth Portfolio, will join us from Mumbai to take you all through the broader economic trends and update you all on the ASK Growth Portfolio and the way forward. Now, let me highlight something about Sandip. Sandip has a total work experience of almost 2 decades. Sandip joined ASK 2 years back from SBI Life Insurance, where he was heading the investment research for equity and debt, and also was donning a hat of an equity fund manager. Prior to SBI Life, Sandip has worked with marquee names like UBS, Kotak Institutional Equities, KPMG, and Citibank. As far as the qualification side is concerned, Sandip is a qualified chartered accountant. He is also a company secretary, and he holds a master's degree in business administration from IIM Ahmedabad. Now, this session will be followed by Q&A. I would request you all to type your questions in case you have, or any queries related to the macro aspects in the Q&A box. We'll try and get them all answered. I would now welcome Sandip to take things forward from here. Welcome, Sandip.
Yeah, thank you so much, Jatin. Thanks a lot, everyone, for logging into the call today. I'm sharing my screen, Jatin, and please do let me know once it's visible.
Yes, it is visible. Thanks.
Okay, yeah. Jatin, I'm changing the slides. Is the slide change visible?
So I can see the first slide. Yes, the next slide is there. Yeah.
Okay. Okay. Thanks a lot. So friends, we'll start off on the macro side. There's been a lot of negative news flow all around regarding high inflation, the war in Europe, record debt levels globally. The geopolitical scenario is not looking good globally. So, how do we think about the economy, the markets at this juncture? So we'll take you through some of our key thoughts around that, and also the growth portfolio. And as Jatin said, at the end of it, we'll be happy to address any questions or queries that you might have regarding the economy, the markets, the portfolio, etc. So just to set the context, in 2022, Nifty was actually a stark outperformer versus global bonds as well as global equities. For global bonds, it was one of the worst years in recorded history. Global equities were also not good at all, as we can see. This data is all in USD terms. Nifty, however, stood tall, relatively speaking, amongst the global markets last year. This year, we've seen a bit of a reversal of the trend, with global equities and also bonds doing better than what Nifty has managed to do so far in the year. as far as the fundamental outlook for the Indian economy is concerned, in the global context, that still continues to remain very good. So 2022 was a year where, the global economy, let's say, grew at 3.2%. In 2023 calendar year, the IMF forecasts obviously global growth to slow down. So it is expected to grow more like 2.7%. India's growth rate is actually still going to remain at a healthy 6% plus. It is one of those large economies where the slowdown in the growth rate is actually going to be the least. And it is going to be the fastest growing large economy globally. There's only one economy, which is China, which is going to accelerate its growth rate from 2022 to 2023. And that is because, China has opened up. It was in some sort of a lockdown or another for the last few years. But other than that, if you look at it across the emerging and the developed world, there is expected to be a slowdown. While for India, the slowdown is relatively much less, and India is still going to remain amongst the fastest growing large economies. If we look at inflation, the blue line in this chart, the dark blue line highlights inflation globally. And the light blue line below that is basically the US Fed funds rate. What it seems from this chart, which we will also discuss in the following slides, is that the peak of inflation, is potentially behind us. Fed's funds rate, obviously, the Fed has indicated that, it will continue to fight inflation with increasing rates. So that is going to continue for a while. But inflation, globally might have peaked. And, we'll just come to the reasons for the same. Firstly, if you look at commodity prices, which are a big driver of inflation, from their 52-week highs, if you look at it, commodity prices have fallen anywhere between, 20 to 50%. Financial year to date, also, we can see, a lot of these commodity prices are down. We are a energy hungry country. We are a commodity hungry country. So whenever obviously commodity prices come down, it is good for us. And globally also, it is one of the signals that inflation is potentially, coming off. The other aspect of inflation is oil prices. So if you look at oil also, that has corrected by around 33% from its peak levels. Natural gas prices have also similarly, come down. They have actually been more sticky than oil, but, in recent times, they have also come down. We in India are obviously procuring a good 25% kind of a number of our oil requirements from Russia, wherein we are getting an additional discount of around 20 to 25%. So our import basket cost is actually down even more. So, on the energy side also, we seem to be better placed now versus what we were, let's say, a year ago. Freight rates, they are also a big component of inflation. So if you look at it, freight rates had gone berserk during COVID times. Now they are down 85% plus, and now they are about pre-pandemic levels now. So, this also a big component of inflation now seems to be getting under control. So, what we've seen in the last few slides is the key drivers of inflation, are coming down. In terms of interest rate hikes by central banks, we might not yet be done. They might have some more distance to travel. But obviously, the key drivers of inflation are in control, and monetary policy works with a lag. So, that will also have a concomitant impact on underlying demand in the economy, and then again, underlying inflation. So to that extent, things from here, maybe the worst is behind for inflation, and, maybe for the interest rates, we have a little more distance to go. Food price have also been, quite elevated in recent times. Therein also, we've seen a correction from the peak by around 15 to 20%. But, food prices are one basket which still remain at relatively elevated levels. For India, this year is going to be crucial from a monsoon perspective as well, because there have been some concerns around El Nino, impacting monsoons in India this time, and that could have an impact on food prices, and that is one of the key variables which we will be watching over the next few months. Now, if we speak about the domestic economy, trade balance in India, the goods trade balance had actually hit a big negative number. And this is because both commodity prices and energy prices were high. We are net importers into the country of both these things. And obviously, our trade balance got severely impacted because of this. And at the same time, there was a global growth slowdown. We believe that the worst will be behind for us in this financial year. So if you look at in FY23, our current account deficit will be amongst the worst levels over the last few years. But next year, which is FY24, we are likely to revert to the pre-pandemic levels of FY19. So to that extent, maybe the worst on the external account balances is also likely behind us. If you look at our forex reserves, there were some concerns around the forex reserves dwindling in the latter half of last year. A part of it was because RBI was defending the rupee, and a greater part of it was because of mark-to-market losses on the US treasuries and other foreign government bonds that we hold. But that tide has turned, and we are accumulating foreign reserves. And anyways, our forex situation continues to be comfortable. This becomes a bit more important in a global environment which is very volatile. But having said that, our macro management of the economy has been relatively better compared to the rest of the globe during the pandemic times. And to that extent, we are standing in good stead. A few of the other domestic indicators, if you look at GST collections again continue to be healthy. Month on month, the number that is coming out is good. Our direct tax collections also continue to be healthy. Some of the other regular or frequent indicators that we look at, let's say like credit growth, credit growth is in the mid-teens levels, which also continues to be good. So overall, the net picture on the macro side that is turning out is that India is in a relatively better position versus the rest of the globe. In the rest of the globe, obviously, a few concerns continue. The biggest is obviously the continued conflict in Russia and Ukraine. And the second thing is that the world has not seen an elevated interest rate regime for a period of time. So, globally, we are seeing the highest interest rates in the last 15 years. We've not seen an elongated time frame of elevated interest rates for a while. So, what ramifications that could have globally is something which we would watch out for. On the domestic side, we are relatively more comfortable. A couple of things we would watch out for on the domestic side is the monsoons, because there have been concerns on a rural slowdown for a while now. We have been seeing some green shoots lately on the rural side. The Rabi crop is also expected to be good. But we'll be watchful of the El Nino condition. On the domestic urban side also, lately there have been some muted commentary on volume growth side. That is the other thing which we will be watching over the next few months. But other than that, the domestic looks more comfortable versus the global scenario, where we have these concerns primarily emanating from the situation in Europe and a longer than expected higher interest rate environment. Other than that, what are the things that we continue to like on the macro side? The government continues to do very good work on the policy front. So we are seeing a lot of work on infrastructure, logistics. The entire manufacturing ecosystem is developing quite well. We are seeing a whole lot of sectors benefiting from the PLI scheme. Those benefits will continue to flow through in a more vibrant manufacturing ecosystem in the economy. Balance sheet side, on the corporate side, we've seen deleveraging. On the household sides, the balance sheet continues to be comfortable. And on the banking side also, because of the capital raise during the pandemic times and the cleanup that has happened in the banking balance sheets, and the fact that NPAs are now very low, we are seeing all three engines of the economy in a fine shape, and government tax collections also continue to be healthy. Now coming on the flow side and on markets. So markets, between October 21 and July 22, we saw around $35 billion of outflows. This was one of the highest recorded outflows in the Indian market history in a concentrated time frame. But from July onwards, July to November, we saw good $7 billion or so of inflows. Last couple of months, again, markets have been volatile. We have seen outflows from FIIs. But over the longer term, structurally, we believe that money will continue to chase higher growth, higher yields, which we believe in the medium to long term, Indian markets will continue to offer. On the domestic side, the flows continue to be very healthy and sticky. So if you look at from a December 20 level of around 8,500 crores or so, SIPs are now closer to 14,000 crores. In addition to this, we have sticky inflows of money coming in from EPFO, NPS, and also insurance. So, we have $2 to $2.5 billion of sticky inflows coming into the market on a regular basis. And obviously, the best thing for any markets and economies if domestic capital supports domestic growth. And to that extent, we are seeing, the sticky money proportion kind of rising from the domestic side. On the earnings growth side in the markets, obviously last 2 years have been very good for the markets in terms of earnings growth. Over the next couple of years, we are seeing around 13 to 15% kind of earnings growth for the market as a whole. So low to mid teens kind of a number for the market should continue. If we talk about valuations, if you look at the market, valuations are at about fair levels from a 10-year perspective. The markets are going to be determined by a number of events and news flow. As we discussed, the domestic situation seems to be relatively better compared to a few concerns on the global side, and near-term market movements will continue to reflect that. How are we positioned in the growth portfolio, and what are we doing? Maybe next few minutes we'll spend on that before moving on to the Q&A. On the portfolio construct side, the growth portfolio continues to be focused on investing in high growth stocks which have good quality, a long runway for growth, and which are a compounding machinery and which continue to deliver a healthy and consistent earnings growth year on year. We continue to have an approach of having a portfolio of around 23 to 24 stocks running concentrated positions. Our key overweight positions are in the consumption side, because consumption, we believe, is a long-term structural compounding story in the country, given the large population base and the huge under penetration as well. The other big position for us in the portfolio is financials. Financials, we continue to remain focused on businesses that are more towards lending to the retail and the SME side of the economy, which is relatively more profitable and more higher and consistent growth as well. We have a decent enough overweight position in two other sectors, which is industrials, and manufacturing, wherein we believe that a lot of work has happened in the country on the policy side, as well as there are structural tailwinds available due to China plus one, Euro plus one, and also import substitution as the country is looking towards substituting a lot of low manufacturing imports that we did earlier, and also focusing on exports for the rest of the world. So that is the way the portfolio positioning continues. If we look at the key psychographics of the portfolio, the key metrics that matter to us. So let's look at earnings growth. While we talked about an earnings growth of, let's say, around 14% odd for the market, the earnings growth for our portfolio continues to be about double of that. So we are looking at a 25% kind of an earnings growth for our underlying portfolio. The return on capital employed, which is the other key metric for us, which in some sense highlights the quality of the portfolio, that also continues to be around 33 to 35%. This would also be around 70-80% higher than that of the market. If you look at the debt to equity ratio, which shows the underlying leverage positions of the companies in the portfolio, that continues to be very, very comfortable at, let's say, around 0.1x or so. For the market as a whole, this would be significantly higher. So net, the portfolio underlying growth and the return on capital matrix, as well as the leverage, etc., also continues to be really fine, and much higher than our benchmarks. So our benchmarks for the portfolio is a minimum earnings growth of 15%. Our benchmark for the portfolio is a minimum return on capital employed of 25%, and on both of these we track the underlying portfolio continues to track much better than the minimum expected levels. How has the underlying portfolio earnings growth been so far? If you look at Q3, the operating profit growth of the portfolio was 20% versus 12% for the Nifty. If you look at for the 9-month period also, the operating profit growth is, was about double than that of the market. So, in the historical delivery also has been, much better. And, as discussed, we continue to the same to be going forward as well in FY23 and 24 as well. Just the last slide on portfolio performance. If you look at it, last year, the portfolio performance was impacted, and, we'll come to the reasons for the same. Before that, if you look at it, till last year, I think on a 3-year basis, 5-year basis, or a 7-year basis, the portfolio is doing well. Last year, basically 3 key things happened with the portfolio. Firstly, the overall benchmark itself, the performance was very concentrated in a few stocks. So around 7 stocks gave the entire return for the benchmark. This was very concentrated performance. And, in many of the names, we were not present. Anyways, we run a more diversified portfolio than that. Secondly, there were few pockets of the benchmark which we were not invested in and which did very well. So these examples would be, let's say, PSUs, public sector banks, or public sector stocks like defense, etc. We've historically not invested in these names because we found the performance to be more sporadic, where it comes in spurts. These businesses have not performed for a long while, but then there comes a year where they give a superlative performance in terms of stock price. Our investing style is more compounding and more consistent businesses in nature. So that is why we've stayed away from that pocket, but that pocket did very well last year. In addition to that, we've not invested in the auto sector because, therein we believe that it is very important to be on the right side of change. There is a big transition happening to EVs, while that space did very well last year. In addition to that, a few of the stock calls that we've taken, the businesses have been going through a rough patch. I'll just take maybe an example of, let's say, maybe Gujarat Gas. It's a very good business. It's the largest gas utility in the country. But unfortunately, because of the Russia-Ukraine conflict, the gas prices went through the roof, and that kind of impacted the demand of Gujarat Gas from a key client cluster of Morbi. And unfortunately, that impacted the earnings and hence the share price. So there are a few macro issues that a few of the stocks have been going through. And we've made a few changes to the portfolio. For a few of them, we just believe that we need to give them some more time so that things settle down, and then the business performance and the stock price performance will come back. Yeah, so this is it from our side. Jatin, now we'll be more than happy to address any questions. Thank you so much.
Yeah, I would request participants to write their questions in the Q&A box so that we can take it forward with Sandip. There were certain questions we had circulated this meeting in advance, so certain questions had come. So I'll start with them and then add on the questions that are coming. So one question that came to us was people were very happy with the outperformance that the portfolio has shown since inception. So since inception, the underperformance, the outperformance has been around 5 percentage points vis-a-vis benchmark. And the good part of the portfolio is that it has served for more than 22 years. So it has a huge legacy. But if I talk about the recent 1 year, as you highlighted and you covered also that particular part, in the last 3 years, there has been some moderation. And if I talk about last 1 year, there has been a significant underperformance. Any particular reason that you want to highlight? In the last 3 years, 2 major events have happened. One was COVID, and second one was the Russia-Ukraine crisis. So also to highlight one thing, that in Q3, in Q4, so in the current January and February quarter, we have seen outperformance of 3 percentage points. So the question in the minds of the investors and participants is that do we believe that the kind of performance in the last 2 months that we have seen in this calendar year will continue, or there will be some some more pain left in the portfolio going forward?
No, thanks, Jatin, for the question. So addressing the last part of your question first, obviously we would like to hope that the recent good performance continues. But honestly speaking, to give a strong commentary around that would be very difficult, because markets will do what they have to do. What we focus on is the portfolio construct and how the underlying businesses are doing. So the underlying business growth, as we discussed, continues to be healthy. Obviously, there are a few stocks, which, as we discussed, have been going through a rough patch. But other than that, the underlying business growth continues to be well. Historically, we've seen that market returns have been in line with earnings growth. So, if the underlying business potential plays out, one would like to believe that, there will be a catch-up. Obviously, it's very difficult to say when exactly that is going to happen. In terms of your question on, what happened in last particular year and obviously the previous few years as well. So, as we discussed, barring if you just take out 2022 aside, till 2021, as you rightly said, the portfolio has outperformed on a 3-year, 5-year, and a 7-year basis. Last year in particular, and let's say during the COVID times, if we want to say in general, what has happened is that relatively speaking, what we believe is the higher quality basket of the market, that portion of the market has not done as well as the broader market. Or let's say, to put it differently, maybe what we do not perceive to be high quality, that portion of the market has done relatively better, right? So to that extent, we were under invested in that portion of the market, and that portion of the market went down. So, that was one of the reasons for we not doing relatively as well. So, few of the buckets is, let's say metals did well. We generally do not invest in cyclical businesses. Public sector owned businesses have done well. What we've seen is that with metals, with public sector owned entities, there are a good period of 3 to 5 years wherein the businesses do not do that well. The stock prices might not also do anything, but there'll be that 1 year where they do significantly better than the rest of the market. And if you are not invested in those names for that 1 year, one looks particularly bad. But given our style is more consistency of earnings, more certainty of earnings, more predictability of earnings, and investing in those kind of businesses, we've stayed away from this pocket. And unfortunately, over the last year, especially, and the last couple of years in general, that bucket has done very well. Secondly, auto OEMs. Because we believe that there is going to be a big transition to EV that is already happening, it is very important to be on the right side of disruption. The auto sector was badly impacted during COVID. In the last few months in the year, they've come back strongly. And that has kind of reflected in the pent-up demand for them as well as in the stock prices. But we do not want to participate in such sporadic performances. We are rather focused on long-term and consistent performance, so that has also impacted our performance. Then, as I said, there were a few of the businesses that we were invested in the portfolio, but they are going through a rough patch. Gujarat Gas we spoke about. Let's say another example is DV's. It's a very strong business, but they had a large order for vaccination. That order has gone. In addition to that, they are going through a bad pricing cycle, which happens in the API industry. Thirdly, what happens is that they get large contracts from innovator pharma companies. Those companies dialed down on their R&D efforts during COVID times, which impacted the pipeline of this business. While this business is going through a rough patch, what we focus on are the inherent capabilities of the business. Is there any impairment of the business model? Is there anything which has permanently damaged its infrastructure, chemistry skills, or its client relationships? And the answer to all of that is no. So we continue to hold. So for some of them, we believe that, as the tide turns, we will see that, earnings growth will come back. So to answer your question in a nutshell, yes, the portfolio has been impacted due to these reasons over the recent past. And we believe that some of them are not structural in nature, and so for some of the other things, the businesses and the stock prices will bounce back hopefully.
Okay, there is one more question on the market capitalization side. So the portfolio, roughly 2/3 of the portfolio is into the large caps, and 1/3 of the portfolio is into the mid caps. Why we don't take any exposure in small caps? Is it the construct of the portfolio? Because since it's a flexi cap portfolio, are there not enough opportunities available in the small cap space? That is point number one. And secondly, there is, you would also agree with me that in the last 6 months, the PSUs have done exceedingly well. Specifically, if I talk about PSU banks and PSU defense stocks. But investors are unable to find any PSU name in the portfolio. Is there any specific reason because of the cyclicality element or something more? There is something more to it.
Sure. So to answer your first question first, this is, as you rightly said, is a flexi cap portfolio. While selecting stocks, we actually are not giving any weightage to the fact whether it's a mid cap or a small cap or a large cap. Our unit of investing is the cash flow and the sustainability, predictability, durability, quality of those cash flows. For us, market cap is not a determinant of whether the stock will come into the portfolio or not. Obviously, what we are mindful of is the liquidity constraints, etc. But many of the small caps kind of fulfill that criteria, so that is not a challenge. What we see that that large caps are currently comprising a larger percentage of the portfolio is more an incidental outcome rather than by design. Obviously, one thing which is there for the small cap bucket in general is that, we are very focused on the quality of the business. And when we say quality of the business, for us, the certainty, the predictability, the robustness of the cash flows matter quite a lot. We would, since we invest for the long term, we would like to see businesses outperform over economic cycles and over interest rate cycles. For some of the small caps, maybe the inherent strength of the business is not yet achieved, because of which we do not get that high level of confidence in them to deliver a sustainable earnings growth through the cycle. Having said this, we've owned small caps in the past, and there is no constraint for us to kind of own them in the future as well. If they meet our criteria of quality, we'll certainly go for them. As you know, they more than meet our criteria on growth. Quality is where we tend to do more work to get ourselves convinced first. On the PSU bucket, we do not have anything against PSUs in general per se. It is just that historically we've seen that performance comes in patches, and because of maybe lack of longevity of management, and a lot of the other things in place, the consistency of performance over the long term does not play out. Our ability to predict a year or two in which the business will perform, and for the remaining years when the business will not, then it becomes quite difficult. We do place a lot of value to the management of a business, and that is why we generally stayed away from the PSU basket. Having said that, if there is a great business to own, we will surely evaluate it. Let's say there is a PSU that we own in the portfolio in terms of Gujarat Gas, but the management over there is very dynamic, and that's a utility business which is like a monopoly, a business in nature, and management has been doing a very good job of execution in terms of expanding its network, etc. So there is no to PSUs. There is another interesting space which is there, which is defense, which is dominated by PSUs. We obviously continue to closely evaluate all opportunities, and if we find that we can see that long period of growth in a particular business, then we would like to go ahead and evaluate it. But obviously PSUs we would evaluate with a slightly closer lens.
Okay. Also, we have seen that there is a overweight position in consumption names, chemical names, and infra names, whereas in IT, telecom, and financials, you are underweight vis-a-vis BSE 500. Any particular reason why we are underweight on IT, telecom, and financials and overweight on other segments?
Sure. So, the sectors that we are overweight on is because, consumption, we believe, is a very long-term structural story in the country because of the demographics, because of low income levels, and because of low penetration. We believe that the headroom for growth for a lot of these businesses is very, very large, multiple times of what their current size is. Hence the structural overweight position. Consumption obviously is a very big space, which different shades and colors, and we are kind of represented in many of them. For us, chemical industrials, as we said, is a very exciting space because a lot of work is happening over there, and we believe that it's a long-term structural theme for the country. In the industrial space, infrastructure, we are not directly present in capex heavy businesses or debt heavy businesses, because that is generally not our style. We are present in businesses that are associated or ancillary industries to the overall infrastructure industrial space. We are present in a pipes company, we are present in an explosives supplier, where we believe that multi-period growth is there in the offing. On the manufacturing side, chemicals is a very interesting opportunity for us, where we are again overrepresented versus the index because of global diversification of supply chains, import substitution, China plus one, as well as we believe that Euro plus one will also pan out. We see chemicals as a very big beneficiary of all of these structural trends, and that is why the overweight position over there. Now, obviously, these overweights need to be funded from somewhere. Let's say we've funded it from IT, is one of the major sectors where we are underweight. IT meets our criteria on quality very well. Obviously, it fits the bill to the T. But unfortunately, on the growth side, IT is not a very high growth sector. While digitization is a structural theme, IT services, unlikely to deliver 15% plus kind of an earnings growth, which is our minimum requirement on a continuous basis for a longer period of time. So that is why we are relatively underrepresented on IT. Obviously, whenever in any interesting opportunity comes through, we will surely add into that segment, because we believe that while the theme is structural, on the growth side, we need to be surer, and obviously, valuations also need to come within our range. On the financial side, we are relatively more focused. Financials, we believe, is a great theme, by the way. We are relatively more focused on lenders which lend to either the consumers, retail space, or to the SME space. Because we run concentrated portfolios, the number of names that we are invested in the financial spaces maybe 5 or 6, versus the benchmark might be having a lot more names. So we are running concentrated positions on retail SME financiers in general, but the space per se we like, but it is just that in a portfolio construct we need to find space for all the sectors that we like, and we kind of like consumption, chemicals and industrials relatively more, and hence financials, which has a large weight in the index of around 30%, to that extent gets slightly underrepresented.
Yeah. So since you're talking about financials, I just wanted to understand about one particular stock where the queries have come on Aavas.
Sure.
So Aavas, I think we exited for a loss. Any particular reason? Earlier we were very gung-ho on the future prospects of Aavas, and then we exited. Could you please give the reasons why we exited that particular?
Sure. So Aavas, Aavas was an exciting story and is an exciting story, perhaps on the affordable housing space. Unfortunately, the delivery on the numbers was below our expectations. The growth was not exactly panning out as we had forecasted. Plus, the management was carrying a lot of excess liquidity on the balance sheet for a long period of time. So what happens is that obviously, COVID times have been quite uncertain, and it was good to carry excess liquidity then. But what happens is that if we carry excess liquidity on the balance sheet in a financial business for a long time, while the return on assets are good, the return on equity comes down. So even a good return on asset delivery will not translate into a good return on equity. And at the end of the day, we as equity shareholders, would be interested on how return on equity is. And for return on equity to meaningfully increase with a high liquidity on the balance sheet becomes a challenge. So because of these few reasons, we exited the stock. And we entered names wherein we believe that growth could be better with a better ROE. So we do not run cash positions, so we exited one financials names, and we put the money into another name.
Okay, so essentially you're trying to say that Aavas was in the business of leveraging, but it is not leveraging.
Yeah, I think you've put it simply and in a better way. Yeah, to some extent what you said was true. So we shifted to a name which was, let's say, in a way better levered and was delivering a better growth and a better ROE number than ours.
Yeah. One more question that what are the changes that we have done? So you have, as I already highlighted, that there was some pain in the portfolio in the recent 1 year, and there has been some bounce back in the recent past. So could you please highlight what are the material changes that you have done in the portfolio, like some names that you have exited in the last 1 year or some names where you have entered?
So, overall underlying thought and philosophy of the portfolio continues to remain unchanged. We would not like to make too many changes to the portfolio unless we believe that, there's a change in the business model, or let's say there is a better opportunity that we can identify, or there is a change in the management outlook, or, we've realized that we've made a mistake. Other than that, if the business is good but going through a rough patch, we would want to hold that at least for a period of time. But let's say, some of the recent changes that we've made is that, we've added IndusInd Bank to the portfolio. We've added Ambuja Cements to the portfolio. We've added Bharti to the portfolio. A few of the names that we've exited is, let's say, Aavas we exited. We've exited Aarti Industries in recent times. We've exited Shree Cement. For some of them, let's say like Aarti Industries, we thought that the impact to their business because of the situation in Europe, is going to continue for a longer period than, what we had originally envisaged. They export chemicals, a good part of the business is exports, and, that was impacted. So we waited for a while, but, when our confidence in the revival of the business got elongated, we realized that, we need to make a change in the portfolio. So there are these kind of changes that we'll continue to make in the portfolio, as in when we believe that there is an appropriate time.
Yeah, I think just a generic question that came about the recent announcement in the budget that came on 1st of February. So there was a huge thrust on infrastructure capex. So the government has earmarked 10 lakh crores, and in addition to that, there is an overall outlay of 13.7 lakh crores. Do you see at this juncture, when no material changes have been done in the last 1.5 months, do you see that this kind of capex will, impact positively our overall portfolio? Is it good for India Inc.?
Yeah, sure. So, the quality of the expenditure that the government does obviously makes a big difference to, how the economy will shape out, not only in this year, but in the future years as well. So what we've seen in this budget is that the component of the capital expenditure of the budget side has been increased. What that does is that increases the long-term earnings potential of the country. Obviously, it needs to be done year on year and just not in one specific year. It eases supply side constraints. India for long has been a supply side constrained economy. Obviously, any capital expenditure has a multiplier effect, on economic growth and on incomes. So to that extent, it is good for the economy, good for India Inc. We are running an overweight position, if one may say so, on the industrial side. We are invested in a couple of names, and we obviously believe that this is a multi-year story, and the portfolio will continue to benefit out of the same. We continue to be on the hunt for more names to be added in this side of the portfolio, but unfortunately, this is a business which is requires generally a lot of investments from the balance sheet, and it's a low return on capital business. So we have to be very careful. Our choices to that extent become limited. But yeah, we continue to be bullish on that space, and it is well represented in the portfolio as well.
Well, Sandeep, it seems that we don't have any further questions. On this note, I would like to conclude this session. Also, on behalf of ASK Investment Managers and the entire team, I thank all the participants for taking time out and attending this webinar. Once again, happy Holi, and for all the women participants, a very happy International Women's Day. Thanks.
Thank you so much, everyone, for joining the call. Have a good evening.